All right, so you're thinking about dropping 10 grand into Berkshire Hathaway and seeing if it grows into a retirement nest egg.
Oh, yeah.
Bold move. Let's unpack this Motley Fool analysis from March 9, 2025.
Okay.
And see if they think it's a smart one.
Right.
Especially with Warren Buffett stepping down soon.
It's definitely a fascinating case study.
Yeah.
We're not talking about some fly-by-night tech startup here.
Right.
This is Berkshire Hathaway,
Mm-hmm.
a company with a history of beating the market for decades.
Yeah.
Thanks in large part to Warren Buffett.
6 decades is a pretty impressive winning streak.
It is.
But the question on everyone's mind is, can they keep that up
Yeah.
without him at the helm?
Right, and that's what makes this Motley Fool article so intriguing. It dives into their long-term investment potential, both the impressive track record and the big question mark hanging over the future.
So before we get into the crystal ball gazing, remind me why everyone's so obsessed with Berkshire Hathaway in the first place. What makes them so special?
Well, for starters, their returns have been phenomenal. The article says that if you'd invested $10,000 30 years ago, you'd be sitting on around $341,000 today.
Hold on.
Yeah.
Let me grab my calculator.
Right.
Yeah, that's way better than just sticking it in a savings account.
For sure.
But a lot of companies have good years.
Right.
What makes Berkshire Hathaway different?
It's the consistency.
Okay.
They've consistently outperformed the S&P 500 since 1965.
Wow.
That means they're not just riding market trends.
Right.
They're actively beating the average year after year.
Right.
And get this, their operating earnings have grown at a compound annual growth rate of 16%.
Okay, hold up.
Yeah.
Compound annual growth rate.
Yes.
You know, I'm all about learning, but you got to break that down for me and the listener.
Yeah, of course.
It's like we're back in high school economics.
Fair enough. It's basically like earning interest on your interest.
Okay.
Think of it this way. If you get a 16% return 1 year, the next year you're earning 16% on the original amount, plus the 16% you already made.
Okay.
It creates a snowball effect that leads to much higher returns over the long term.
Okay. I get it. So it's not just that they're growing, it's that the growth is accelerating over time.
Right.
That's how you get those crazy impressive returns.
Exactly.
But what's the magic formula?
Yeah.
How are they doing this?
Well, the article points to one big factor.
Okay.
Their unique approach to insurance.
Insurance.
See, most people think of insurance as just a necessary expense.
Right, right.
But for Berkshire Hathaway, it's the foundation of their investment strategy.
Okay, I'm intrigued.
Yeah.
Tell me more.
Sure.
How does insurance make the money?
Yeah.
Don't they have to pay out big bucks when disaster strikes?
They do, but here's the key.
Okay.
They collect premiums up front.
Okay.
And that money sits in their account until they need to pay out claims.
Gotcha.
This gives them a huge pool of cash to invest.
Yeah.
It's almost like a giant subscription service that brings in steady income, rain or shine.
So it's a constant flow of cash even when the market is going haywire.
Yeah.
That's smart.
It is.
But don't they take on a lot of risk with all those claims?
Actually, insurance is surprisingly resilient.
Really?
Especially during economic downturns.
Okay.
People are less likely to cancel their insurance when money's tight.
Right.
So that revenue stream stays pretty stable. And Berkshire has been snapping up insurance companies.
Oh, wow.
Like GEICO, Gen Re, and Allegheny.
Yeah.
Further solidifying this cash-generating machine.
So they're using the insurance profits to fund even more investments.
Exactly.
That's starting to make sense.
Right.
And that brings us to their other big advantage. They use that cash to invest in those rock-solid blue-chip companies we all know.
Right.
Apple, American Express,
Yep.
Coca-Cola. Companies that have a history of paying dividends and weathering economic storms.
Right.
So it's like a double whammy.
It is.
Steady cash flow from insurance, plus a killer portfolio of stable investments.
Yeah.
No wonder everyone wants a piece of the action.
Sure.
But let's get real for a second.
Okay.
The article keeps mentioning Buffett stepping down.
Right.
Isn't that a huge red flag for anyone thinking of investing now?
That's the million-dollar question.
Yeah.
Warren Buffett is a legend.
Yeah.
And his partner, Charlie Munger, passed away back in 2023.
Oh.
Even key figures like Ajit Jain are starting to step back.
Right.
It makes you wonder, can anyone really fill those shoes?
I mean, they built this incredible empire.
We did.
But is it tied to their individual genius?
Yeah.
Or is the system itself strong enough to keep chugging along without them?
Right.
That's what I'm worried about.
It's a valid concern.
Yeah.
And to make things even more interesting, the article points out that Berkshire Hathaway has been sending some mixed signals lately.
Like what?
They've hit the pause button on stock buybacks.
Wait, back up. What are stock buybacks, and why does it matter that they stopped?
Yeah.
I feel like this is important, but I'm drawing a blank.
It's basically when a company uses its profits to buy back its own shares.
Okay.
It's a way to signal confidence in their future and potentially boost the stock price.
Right.
But Berkshire hitting the brakes on this could indicate they're worried about the market.
Yeah.
Or maybe about their own ability to keep performing without Buffett at the helm.
Okay, that's a little unsettling.
Yeah.
Is there anything else that's giving investors pause?
Well, on top of the buyback pause, they've also started selling off some of their biggest stock holdings. Like they're trimming the fat and getting ready for something.
Oh, okay.
And they've been hoarding cash and T-bills.
T-bills. Those are like super safe government bonds.
Yeah.
Right?
Exactly.
So they're playing it extra safe with their money.
They are.
That's not exactly a vote of confidence in the market, is it?
It definitely raises questions. It could mean they see trouble ahead and are hunkering down.
Right.
Or it could just be a temporary strategy shift.
Okay.
It's hard to say for sure.
All right, so we've got this legendary company, killer returns.
Yeah.
And a system built on insurance and blue chip investments. Sounds great on paper.
Right.
But now we've got Buffett riding off into the sunset and the company making some pretty cautious moves.
Right.
This is a tough call.
It is.
So what does the article say about their potential future?
Okay.
Is Berkshire Hathaway destined for greatness or headed for a fall?
The article doesn't offer any guarantees.
Okay.
But it does outline a couple of possible scenarios for Berkshire Hathaway's future.
Right.
And it all comes down to what their successors decide to do.
Okay, let's hear it.
All right.
What's the best case scenario?
In the first scenario, the new leadership sticks to Buffett's playbook.
Okay.
They focus on finding undervalued stocks, making smart investments, and letting that compound growth work its magic.
Right.
Basically, they keep the ship sailing in the same direction, even if the captain has changed.
Sounds reasonable enough.
Yeah.
But can they really pull off a buffet without Will Buffett?
That's the big unknown.
Yeah.
But if they can maintain that same discipline and wisdom, the article suggests they could continue to outperform the market.
Okay.
They're projecting a potential return of $174,500 to $662,100.
Whoa, hold on.
Yeah.
That's a huge range.
It is.
How could they be so unsure about the potential return?
It all boils down to the growth rate they achieve.
Okay.
The lower end assumes they basically keep pace with the overall market, around 10% annual growth.
Okay.
But if they can hit that 15% growth they've achieved historically, well, that's where you get those eye-popping numbers.
So if the new team can maintain the magic, it could be a home run for investors.
It could.
But what happens if they try to reinvent the wheel?
That brings us to scenario 2.
Okay.
What happens if the successors decide to shake things up and deviate from Buffett's proven approach?
Let me guess it doesn't end well.
Not necessarily. But the article cautions that straying too far from what works could lead to some serious consequences.
Okay.
They might chase after risky trends, over-diversify, or make big bets that don't pan out.
So they could end up diluting what made Berkshire Hathaway so successful in the first place.
Right.
That's scary. Do they give any hints about which way they're leaning?
Unfortunately, no.
Oh.
The article leaves us hanging a bit there.
Yeah.
But this is where things get really interesting.
Okay.
Because it forces you, the potential investor, to do your own digging.
All right. So we've laid the groundwork.
Yeah.
Berkshire Hathaway has a phenomenal track record.
Uh-huh.
A unique system that's produced incredible returns.
Yes.
But now the man behind the curtain is stepping down.
Right.
And the company is sending mixed signals about its future.
Yeah.
It's a real nail-biter.
It is.
What should our listener keep in mind as we head into part 2 of this deep dive?
The key takeaway here is that Berkshire Hathaway is at a crossroads.
Okay.
The potential for continued success is there.
Yeah.
But it hinges on whether the new leadership can live up to the legacy of Warren Buffett.
Right.
So as we move forward, we're going to dig a little deeper into the specific challenges they're facing and what those cautious signals might mean for the future of the company and for your potential investment.
Okay. Sounds good.
Yeah.
All right, so we've established that Berkshire Hathaway is facing some big changes with Buffett stepping down.
Right.
And the company making some cautious moves.
Yeah.
Let's dig a little deeper into those
sure.
cautious signals the article keeps mentioning.
Okay.
I'm still not entirely clear on what they mean or why they're so important.
Okay.
Can you break it down for me and the listener?
Sure. Let's start with those paused stock buybacks.
Okay.
Remember when a company buys back its own shares? It's essentially saying, we think our stock is undervalued and we're confident in our future.
Okay.
So when they stop doing that, it can raise eyebrows.
It's like they're not putting their money where their mouth is anymore.
Right.
But couldn't it just be a temporary thing?
It's possible.
Maybe they're just waiting for a better opportunity to buy back shares.
That's possible, but we have to consider the context.
Okay.
They were buying back shares pretty aggressively before, and now they've slammed on the brakes.
Yeah.
This combined with the other signals suggests a more cautious outlook.
You mentioned selling off some of their major stock holdings.
Right.
What's the significance of that?
Yeah.
Are they losing faith in their own investments?
Not necessarily.
Okay.
Remember, Berkshire Hathaway has a massive portfolio of companies.
Right.
Sometimes it makes sense to trim a position, take some profits off the table, and rebalance the portfolio.
Gotcha.
But again, the timing is what makes this interesting.
It's like they're clearing the decks, battening down the hatches.
Exactly.
Getting ready for something big or something bad.
Exactly. And then there's the fact that they're sitting on a mountain of cash and T-bills.
Right.
Those super safe government bonds. It's like they're saying, we're not sure what's coming, but we want to be prepared.
Okay, that's starting to make sense.
Yeah.
It's not just one isolated incident. Yeah. It's a whole pattern of behavior that points toward a more conservative approach.
Right.
But why are they being so cautious?
Yeah, that's a good question.
Do they know something we don't?
We can't say for sure what's going on in their heads.
Right.
But it's worth considering a few factors.
Okay.
First, the global economy is facing some headwinds. There's inflation, rising interest rates, geopolitical uncertainty. Yep. It's not exactly smooth sailing out there.
So they could be anticipating a rough patch and preparing for the worst.
That's certainly a possibility. Another factor is the leadership transition.
Right.
Maybe the new team isn't as confident in the market as Buffett was.
Yeah.
Or maybe they're just being extra cautious until they get their bearings.
It's a lot of pressure to step into those shoes.
Sure is.
I can see why they might want to play it safe at first.
Yeah.
But how does all this affect their future investment potential?
Right.
Does this make Berkshire Hathaway a riskier bet?
It's not necessarily about being riskier, but it does add another layer of complexity for investors to consider. The article presents those two scenarios, remember?
Right.
Sticking to Buffett's strategy versus shaking things up.
Right.
And these cautious signals make it harder to predict which path they'll choose.
All right, so let's go back to those scenarios.
Okay.
We touched on them briefly in part one.
Yeah.
But now that we have a better understanding of the context, let's really break them down.
All right.
Scenario one, what happens if they stay the course?
In this scenario, the new leadership embraces Buffett's philosophy. They focus on long-term value, identifying companies with strong fundamentals and a competitive edge.
Okay.
They stay disciplined, avoid chasing fads, and let that compound growth work its magic.
So it's like they're trying to channel the spirit of Buffett.
Right.
Even if he's not physically there?
Yeah.
But is that even possible?
That's the question.
He's a once-in-a-generation investor.
He is.
Can anyone really replicate his success?
That's the million-dollar question.
Yeah.
The article suggests it's not impossible.
Okay.
But it will require a deep understanding of Buffett's approach and the ability to adapt it to the current market conditions.
That's true. The world has changed a lot since Buffett started investing.
It has.
We've got new technologies, new industries, new challenges.
Right.
It's not just about picking the next Coca-Cola.
Right.
So what specific actions would they need to take to stay the course in today's world?
Well, they'd need to maintain that focus on value investing. That means identifying companies that are trading below their intrinsic worth.
Right.
Businesses with solid earnings and strong management teams.
Yeah.
It's about looking beyond the hype and finding those hidden gems.
So they'd need to resist the temptation to jump on the latest trends.
Yeah.
Or get swept up in market frenzy.
Right.
Basically, they need to be boring like Buffett.
Right.
That's tough in today's world of instant gratification and meme stocks.
Exactly.
And they'd also need to be adaptable.
Yeah.
Buffett was known for involving his strategy over time, recognizing that what worked in the past might not work in the future.
Yeah.
The new leadership would need to have that same flexibility, the willingness to learn and adjust.
Exactly.
So it's not just about mimicking Buffett. It's about understanding the principles behind his success and applying them to the current landscape.
Precisely.
Okay.
And the article suggests that if they can do that,
Yeah.
they have the potential to continue generating impressive returns for investors.
Right.
Remember those figures?
Yeah, those numbers are still bouncing around in my head.
$174,500 to $662,100.
But those are just projections.
Right.
There's no guarantee they'll hit those targets.
Of course not. There are always risks involved in investing.
Right.
But the point is, if they stick to the core principles that have made Berkshire Hathaway successful,
right,
they have a solid foundation to build upon.
Right.
Now let's flip the script.
All right, let's explore that darker path.
Okay.
Scenario 2, what happens if they ditch Buffett's playbook and try to forge their own path?
This is where things get a little more unpredictable.
Okay.
It could go well or it could go very badly.
Oh.
It all depends on the choices they make.
Give me some examples. What would shaking things up look like in the real world?
Well, imagine they decide to diversify aggressively into new sectors that Buffett traditionally avoided, like tech startups or emerging markets, or maybe they start making big bets on acquisitions, trying to grow the company through aggressive expansion.
Right. So instead of being that slow and steady tortoise, they become a hare, trying to outpace the competition and make a splash.
Exactly. And that can be tempting, especially for a new leadership team trying to prove themselves.
Right.
But the article warns that this approach carries a lot of risk.
Okay.
They could end up chasing fads, overpaying for acquisitions,
right,
or diluting the focus that made Berkshire Hathaway so successful.
It's like they're gambling with Buffett's legacy.
In a way, yes.
Yeah.
They could get lucky and make some big wins,
yeah,
but they could also make some costly mistakes.
Right.
And the article suggests that this path could lead to stagnation or even underperformance compared to the market.
So instead of those amazing returns we were talking about, they could end up just treading water.
Right.
Or worse, losing money for investors.
It's a real possibility.
Okay.
And that's why it's so important for investors to understand these different scenarios.
Right.
And the potential implications for their own investment decisions.
Okay, so we've got these two very different paths.
Yeah.
Stay the course and potentially reap the rewards of Buffett's legacy.
Right.
Or shake things up and risk losing it all.
Right.
It's a tough call.
It is.
What should our listener be thinking about as we head into the final part of this deep dive?
As we move into the final part, I want you to think about which scenario feels more likely to you.
Okay.
Do you think the new leadership will try to emulate Buffett or forge their own path?
Okay.
And what does that mean for your own investment strategy?
Yeah.
We'll explore those questions and try to come to a conclusion in part 3.
All right. We've gone deep on Berkshire Hathaway.
We have.
They've got this amazing track record.
Yeah.
A system built on insurance and blue chip stocks.
Right.
But now the Oracle of Omaha himself is stepping down.
Yeah.
And they're sending some mixed signals about the future.
Right.
So after all this, what's the verdict? Should our listener take the plunge and invest or run for the hills?
It's a tough call, and honestly, there's no easy answer.
Right.
This isn't like plugging numbers into a formula.
Yeah.
There's a lot of human psychology and market forces at play here.
Okay. No crystal ball predictions.
Yeah.
But we've got to give our listeners something to work with here.
Right.
Let's go back to those two scenarios.
Okay.
In scenario 1, they stay the course, try to keep doing what Buffett did.
Right.
What are the chances of that actually working?
Well, the success of that scenario hinges on whether they can truly grasp the essence of Buffett's investing philosophy.
Okay.
It's not just about copying his moves.
Right.
It's about understanding why he made those moves.
Give me an example.
Sure.
What's a key principle that they'd need to nail to pull this off?
One of Buffett's biggest strengths was his patience.
Okay.
He wasn't afraid to sit on the sidelines, wait for the right opportunity.
Right.
And then strike when everyone else was panicking.
Gotcha.
That's tough to do, especially in today's fast-paced market.
So it's about discipline? Resisting the urge to chase trends or get caught up in the hype.
Right.
It's like being the adult in the room while everyone else is losing their mind.
Exactly.
And they'd also need to be really good at evaluating businesses.
Yeah.
Buffett had an uncanny ability to see the long-term potential of a company.
Right.
Even if the market wasn't recognizing it yet.
Yeah.
That's where those undervalued stocks come in.
Right.
The companies that are flying under the radar but have solid fundamentals.
Yeah.
But how do you even find those hidden gems?
Right.
It's not like they're just sitting out in the open waiting to be discovered.
It takes a lot of research,
Yeah.
a deep understanding of financial statements,
Mm-hmm.
and a knack for spotting trends before they become obvious.
Okay.
It's not something you can learn overnight.
Okay, so staying the course sounds like a real uphill battle.
It could be.
What about scenario 2, where they
Mhm.
shake things up?
Okay.
Is that a recipe for disaster? Or could it actually work out?
It's definitely the riskier path. There's a reason Buffett's strategy has been so successful.
Right.
It's been tested and proven over decades.
Mm-hmm.
But there's also a chance that a fresh perspective could lead to new opportunities.
So it's like that classic dilemma.
Yeah.
Stick with what you know.
Right.
Or take a chance and see what happens.
Exactly. And the article doesn't really give us a clear answer.
Right.
It just lays out the potential upsides and downsides of each path.
Right. So we've weighed the pros and cons.
Yeah.
Explored the possibilities.
Right.
What's the big takeaway for our listener?
Okay.
What should they be thinking about as they decide whether to invest in Berkshire Hathaway?
I think the key takeaway is that Berkshire Hathaway is entering a new era.
Yeah.
And there's a lot of uncertainty about what the future holds.
Right.
The potential for continued success is there.
Okay.
But it's not a guaranteed slam dunk.
So it's not a no-brainer investment anymore.
Right.
You can't just blindly follow the Buffett playbook and expect to get rich. You actually have to do your homework and think critically about the company's prospects.
Absolutely. And that's where this deep dive comes in.
Right.
We've armed you with the knowledge and context you need to make an informed decision.
Okay.
Now it's up to you to weigh the risks and rewards.
Right.
And decide if Berkshire Hathaway is the right fit for your investment goals.
That's a great point.
Yeah.
We've given our listener a lot to chew on.
We have.
But ultimately, it's their money and their decision.
Right.
And that brings us to the provocative thought the outline mentioned.
Okay.
It asks, if you were at the helm of Berkshire Hathaway,
right,
what moves would you make in this market?
That's a fantastic question to ponder.
It is.
Would you play it safe and stick to Buffett's tried and true methods?
Right.
Or would you try to shake things up and forge your own path?
Yeah.
There's no right or wrong answer.
Right.
But thinking through that question can help you understand your own risk tolerance and investment philosophy.
Well, folks, there you have it. Our deep dive into Berkshire Hathaway.
Right.
A company at a crossroads.
Yeah.
With a legacy to uphold and an uncertain future ahead.
That's right.
We hope this has given you a better understanding of the challenges and opportunities they're facing and helped you decide whether to join them on this journey.
Right.
Thanks for joining us.